So,
Please go ahead.
sure, yeah. So basically, as Mr. Krishnamurthy was pointing out quite eloquently that we are broadly at some kind of inflection point, right? That's what you meant, because uh, there was a reality which was there in 2021 and 22, and there is most probably going to be a different kind of world in 2023-24, and that means that the challenges and the opportunities available in various asset class would be different from what we had in last couple of years. So that's a very basic point. Obviously, there is never is a one single point of inflection, but we have to, for the sake of history, point out that there are some points where things change more than it has. So last 2 years has been historic for fixed income in the sense that and just to give a sense that I would be referring to the presentation on and off. It won't be totally guided by the presentation. But yeah, so the last 2 years has been a totally different world for a fixed income market than it has been for last 30-40 years. US getting inflation numbers near 9%, which was last seen in 1981-82 kind of, and fully in 1970s. UK Euro area getting UK getting inflation double digits. Euro area getting inflation in high single digits. So these are numbers which we haven't seen for the last 2-3 decades, and hence it was very understandable how the central bankers reacted. Uh, so it's uh, it's something which was unprecedented, and hence the reaction was unprecedented. Central banks were hiking in a step function of 75 basis point. People were talking there might be 100 basis point hike also, and this kind of thing went on and on. And things are changing now, right? Why are things changing? Things are changing for a simple reason that central bankers are not the central bankers which we had in 1970s. They were very cognizant of things, what were happening, and they have reacted. And obviously, when they have reacted, their actions have some implications, and that they had that are begin to show up. And that's why globally things are changing, and that obviously will mean that in India things will obviously change. So that's the basic crux of it. Let's go slide by slide, and then we can look at things. Just give me a second. Yeah. So as it is appropriate that all our actions which RBI has taken, or the whatever the movement have been in the local markets, have been a function of what is happening globally. And hence, one second. This sound is coming on this phone. Sorry. Yeah. So whatever is happening in the local markets has been a function of what's happening in global markets, and hence it's very pertinent that what our link is with the global market is going to be the most important function for us. That is how the trade deficit is, that is how the imported inflation is, that is how the FX is. So these are have been for the last 1 year the most important variable for us, and they will continue to be the most important variable for us. So let's start with CAD number and trade deficit numbers, right? So trade deficit numbers, it used to be monthly numbers used to be between 10 to 15 billion dollars per month, broadly in last year, prior to June, July last year. And then around July, August, September, it started spiking. It went to around 18, 20 billion, 20, 22 billion. And then it remained there. And then a quarter back, I think in the August or September number, it printed a high of around 30 billion, right? And that was the biggest concern, and it was a huge concern for us. And that's why we saw the movement in the USD INR, which we saw. Now, what we have to figure out is that a new reality for us, or are we are going to be going back to the previous regime, which when we had uh, numbers which were much lower. So our take is that while the 31 billion numbers which we were hearing, which it had been printed, those numbers are somewhat of outlier, but still we have moved up in terms of the trade numbers, and hence we would continue to be in 20-25 kind of $1 billion range of monthly trade deficit going forward also. So what does it mean? It means that these monthly trade deficit numbers are going to be a concern for us, but it's not going to be as big a issue as it was, say, a quarter ago. And hence, we should be cognizant of this number. We should be aware of this number, but we should not be overly worried on this number. And hence, that's why you would see that the similar movement which is reflected in USD INR. So USD INR a couple of months back spiked above 80 and went sharply higher, and then for last couple of months it has remained in 82, 81 kind of range. So going ahead, we expect these numbers to be slightly bad, but it's not going to be a very big worry for us. And hence, the impact on BOP would be quite limited going ahead. The second aspect of BOP was the big outflow from FIIs and FPIs, which was happening. Which again, if you see the numbers, which was unprecedented from January of this year to August of this year, we saw one-way flow happening. Again, that is something which have sort of reversed, and now what we are seeing is a two-way flow, and hence from that perspective also we don't have a huge worry, a huge pain point ahead of us, and we would be seeing some kind of a mix back there, and hence the impact on USD INR is limited. So coming to USD INR, obviously when we are talking about these numbers, our focus is only on how our currency has behaved and how it is going to behave in future, because that's the one variable which is going to alter the behavior of RBI going ahead. So if we see INR performance, it has been sort of middle of the pack. When we see INR performance, it has been in the middle of the pack. So we see some of the EM currencies which are particularly the LATAM currencies which are doing well, but that has been a function of their heavy rate hikes which we have seen in those countries. But apart from that, we have been middle of the pack, and we haven't performed or underperformed or outperformed anybody. So while we see the numbers and rupee going up by 80 from 75 to 82, and we see it is a big worry. More pertinent is how the rupee has behaved with respect to other currencies and with respect to trade-weighted performance. And in terms of both, we have been a median. We have been a median performer, and hence any kind of walls in rupee should not be over a big concern for us going ahead. Coming to inflation outlook. Inflation, again, our numbers, inflation numbers have been on the higher side of the RBI comfort zone, which has been 2 to 6, and hence we saw some kind of RBI action which has succeeded that. But we should have some context on that. The first context is that when you compare our inflation numbers with what has happened in most of the DM worlds, our underperformance is with respect to our target is very marginal, right? So we used to be in a 5.5 kind of range prior to the whole inflation blowing up. We went to 6.5, 7 kind of range. So the underperformance has been by 1.5%. While same with US, it used to be in 2% range and it went to 7-8 kind of range. So the level of deviation in US is order of magnitude higher than us, and hence we while looking at our performance here, obviously we can all say that we might have slipped up in terms of inflation, but these kind of performance evaluation should always have a context. And the context is that we have done very well if we keep in mind how globally things have played out. So to that extent, I think, and providing a context why I'm saying all this is that since our underperformance has been marginal, hence the extent of reaction from RBI should always also be marginal. So that's the basic context of it, right? Looking back, as I said, our deviation has been marginal, and even if you see the last number, it has come between the range 2 to 6. So that should also provide us comfort going ahead. Again, going ahead, what kind of numbers we can expect to see? Going ahead, we can see numbers which would be in the range of 5.5 to 6 kind of average range, which would be again in on the higher side as far as RBI is concerned. But it's not something to be worried about. And this ties up with what I've been saying on the BOP numbers also. These are numbers which are not very comfortable, but these are not numbers which are going to be worrisome. And hence, to that extent, RBI's hand is not going to be forced by this number going ahead in future. If you just give a context of how inflation has been for India, if you see a 10-year or a 15-year kind of numbers, you will find that we have been broadly in 5.5 range. Despite RBI saying that we want inflation to be centered around 4, what the reality is that for last decade or so, we have seen inflation numbers which have rested between 5 and 5.5 range. So a number between 5.5 to 6, which we are expecting, and most of the analysts are expecting going ahead. These are not the numbers which are going to be a huge discomfort for RBI. Obviously, RBI and the governors would be saying in public that it's a worrisome thing, and because that's the job, right? And they cannot say that we have conquered inflation when they are at the higher range, at the higher point of their range. But in terms of action, it's more important to see what they are going to act rather than what they are going to say. And in terms of action, if the inflation is going to be in the range of 5.5, 6, then a number of policy rate of 6.5 seems to make sense, and the policy rate anywhere around 7 doesn't seem to make sense, because that would be overly punishing for the economy. So to that extent, the basic derivation which we can do from these numbers is that if we are going to see inflation between 5.5, 6, which we are projecting and which most of the analyst community is projecting, then we can see inflation broadly, the RBI repo rates broadly around 6.5. Given that we are already at 6 quarters, 6.5 doesn't seems to be a major movement from where it currently is, and hence should be a comfort for the fixed income participants. Now, for last one year and 1.5 years, we have been hearing globally that there are going to be recession fears, there are growth is slowing down and all that, and we have broadly been immune to these kind of worries, right? And this is being reflected in performance of our asset classes like stock market, which we have done very well compared to our peers. And going ahead also, part of the economy seems very resilient, but we are starting to see some kind of worry on the growth numbers also. So FY23 numbers, as we are projecting here, remains between 6.5 to 7 kind of range. But FY24 numbers are numbers which should start to concern us. And we are getting a sense from various analyst projections and things that we can see numbers which can be 5% or can be lower than that. And that can pose a challenge going ahead for RBI. So this is something which investors and we should keep in mind when we are thinking about our asset allocation process. Uh, there are multiple ways to track how the numbers are going to behave. Many of we use the many of the high frequency indicators, like how the car sales are going, how the festival sales have been, how the company performance has been, how various indicators like traffic, port traffic, air traffic, electricity, and various other production like IIP and all other factors are behaving. And while none of these numbers have shown a big concern, you will find that some numbers like IIP or even car sales, or two-wheeler sales, they are starting to moderate, right? And hence, while we cannot put a number out and say concretely that growth is going to be weak, but we are going to see signs. We are starting to see signs that growth is starting to falter a bit, and the full extent of that should start making clear when we are when we get down to project the FY24 numbers. And basic projections are that those numbers are going to be centered around 5%. So to that extent, growth is not as comfortable as it has been in the last 1 year or so, but it can be a problem area for RBI going ahead. On the fiscal outlook, the numbers post COVID, sorry. Yeah, the numbers post COVID have been a bit of a worry. But as we can see, the consolidation process is on, and we can see more of this consolidation process going forward also, and hence these numbers remain a bit of concern to the fixed income participant. But these concerns are going to be going to get better as we go ahead. Um, the corporate tax number, the direct tax numbers have been very good, and hence those will start to support, will continue to support these numbers. And these are not, these are numbers which, as a fixed income participants, are a neutral number for us. These are not either positive or negative number for us in future. Now, coming to global rates, right? So, frankly, for all what RBI has said about our policies, that we are domestic oriented and all that thing, the truth is that we are governed by only, and in this policy at least, we have been governed by only one factor, and which is that how Fed is going to behave, right? This is why in April, RBI April policy, RBI was complacent and was saying that inflation is okay, and didn't seem overly concerned on inflation. And surprisingly, in May, on May 4th, just a couple of days after when Fed has done its first 75 basis point rate hike, RBI comes and does a 50 basis point surprise middle of the policy rate hike. So this just shows that again, the point I've been making, that it's more important to see the actions of RBI rather than go by its word, right? If you go by its word, you will feel that RBI is only concerned about domestic factors and it's not concerned about what's happening globally, or maybe it's a small thing for RBI, but the actions have been very, very opposite of what it has said. And what it has said is that what it has done is that it has followed Fed step by step. Obviously, when Fed is hiking 75, we were hiking 50. But the magnitude for us has been lower because obviously the magnitude of our deviation from also has been lower. But we have followed Fed step by step in our hiking, and hence it stands to reason that if Fed starts stops its rate, pauses its rate hike, then we would follow Fed and start go on that path, right? So if we follow this thought of reasoning process, then our biggest concern as fixed income participant or the participants who are looking at asset allocation is what Fed is going to do, right? And what we are seeing is that Fed is, while the Fed participants, Fed governors have been talking about rates above 5%, and the market participants are talking about rates which are somewhere between 4.5 to 5%. And that would mean that we can see another 50 to 75 basis point more rate hikes, which would mean that by next couple of policies, the rate action for Fed should be over. So again, why is it more important that we take cues from the market and not from the Fed governors is the fact that if you go a year back and see what the Fed dot plots were, Fed dot plots were talking that by the end of the year, the Fed rates, by the end of the year, FY23, Fed rates would be at 1%, right? So obviously market were ahead, and market you saw 2 years and 10 years selling off last year itself. And markets were ahead of the Fed governors, and they were talking about rates going up to 2 to 3%. So as is the case with most markets, it's more important to look at the markets and not see what Fed governors are saying. And if I have to give take a choice between dot plot and what the markets are projecting, I would choose what markets are projecting, and markets are projecting that we would see another 50 to 75 basis point more of a rate hike from here. So given that, again, that would mean that we would see Fed stopping by March of this year. And given that our next policy is in Feb, it stands to reason that there is a good chance that a 25 basis point rate hike in Feb could be the last rate hike which we have. Mr. Krishnamurthy, should I touch on global data points also, or we don't have time for that? Sorry, I cannot hear you.
Sorry, I was on mute. If you could, use these data and translate it to what these mean for investors
Sure.
In terms of going forward, both from an equity perspective, if you can, but more in debt perspective, and why you think debt is a better place going forward, that will be great. Thank you.
Sure. So, see, a couple of things which are happening globally, and particularly US, which is more important, is that some of the employment numbers, if you follow the NFP numbers, it's still high. But if you follow the household survey, you will find that things are flattening in terms of employment there, and you will find that household surveys are a precursor to what NFP behaves. So most probably we are seeing some kind of flattening of employment there, right? Which is going to be the most important factor of Fed. Again, if you have followed the US CPI, the last two prints, both have been on the lower side. And if you remove the shelter part of the CPI, you will find that inflation numbers are much lower than what is coming out of headline. And even in shelter, we are starting to see some kind of moderation. So if we follow these couple of numbers, it stands that there is a good chance that we are going to be at the end of the Fed rate hike in next two policies. Obviously, Fed governors are not going to come out and say that. Why? Because markets have rallied by 10 year has rallied by 50 basis points since around 1.5 months back. The US CPI data came, and after that, markets when US 10 year was at fourth quarter. From there, it has rallied to 3.5, right? Right now it's at 363. So around 75 basis point, it rallied on a couple of data points itself, right? So if a Fed governor now comes and says that it's a good data point, then you can see that it can rally more, right? And why would a Fed governor want that to happen, right? Because it doesn't want market to presume too much, right? So because of that, Fed governors are not coming out and saying that the numbers are coming good, but the fact is that numbers are turning around, right? And what does it mean? It means that if growth numbers are going to be as bad as people are projecting in US, and they are all projecting recession numbers in next year, if you do a survey, if you see all the surveys, around 60-70% of the analysts and the CEOs are expecting next year. So it would mean that next year, last quarter, we should start seeing rate cuts happening in US. And again, if rate cuts happen, then fixed income markets start becoming attractive for everyone, and so on and so forth. So that's the basic premise of what we are talking here, right? And what has the implication for us in the fixed income market? There are twofold implication. Again, I will be conservative. Obviously, beyond a point, a fund manager cannot be too aggressive in terms of when it's talking to investors. But there are two assumptions, two things which are going to play out. First, when the rates are at 6 quarter for us, or 6.5 for us, the 10-year is at 730, 740, right? 1 year CD is at 760, 2-year CD, 2-year bond is at AAA is at 750, 10-year is at 770, 10-year AAA PSUs are 770. So these are the numbers, rates which are in line with an expectation of 6.5 kind of policy rate. So what it means is that if RBI hikes another 25 basis point in next policy and stops there, these rates are not going to go up or down, right? These are rates which are broadly going to remain there. So the first point for an investor should be that is this a good point of entry or not, right? There are two contexts to it. One, is this a good point relative to other options I'm getting? So 7.5 is a very decent rate. If you find the curve is very flat, if you buy a 2-year bond, 3-year bond, all you're getting at 7.5 gross levels, right? So 7.5 is a very decent rate in terms of historical levels. You can see, if you see last 5-7 years history, you'll find the 7.5 is on the higher side. If you see the last 3-4 year history, you will find 7.5 is on the higher side. If you have a context of how other investment options are, then also 7.5 is at the higher side, right? So by multiple measures, 7.5 as an entry point is going to be a very, very good entry point for fixed income investors. And I'm not an expert in other asset classes, but to me, it seems that even compared to that, it seems a very reasonable risk averse bet which investor must play. Obviously, I'm not saying that investors should stick to one asset class and not take, but given that the rates are very comfortably positioned right now, I think it makes sense for all the investors to start allocating their funds at these levels. These are levels which we haven't seen in the last 3-4 years. These are levels which post-tax and post indexation adjustment, you will find these are levels which are very excellent. And given the risk which you can and the walls which you will see here, these are very, very excellent levels. So from the first basis, I think this is a great entry point for some kind of asset allocation for fixed income investors. Fixed income investors have done very well in last 2 years in the sense that both the investors, they have broadly come to the lower duration product, and even the fund managers, they have reduced the duration to the lower end of the spectrum. So you will find gilt funds were operating at 2.5 kind of duration. Other funds were operating at 1 year duration, and even the investors are broadly coming into the low duration product itself. And if you combine both of these, you will find that the net return, the next experience for the investors, while it might not look very great on paper at say 3.5-4% return for the everyone, but if you see the rates have gone up at 300 basis point, 200 basis point in a matter of months, right? So if you have that kind of context, the performance has been very, very good. Because these have been a very, very bad times of fixed income, and in those times the investors have done excellently well on a relative basis. So those investors and those people who have stayed away from fixed income market, and for very good reason, I think it's an excellent time to come back to see it reallocate their money to it because it's an excellent point of entry. The second point is what I was talking, that Fed, we might see some kind of rate cuts happening next year, and we will see some kind of rally in global rates. Coming to rally in local rates, I think it's a bit presumptuous to talk about it because our inflation, as I said, we are projecting to be 5.5, 6, and but historically also we have remained in 5 to 5.5. So our inflation has been sticky on the upper side also. We haven't gone as bad as US has done. So on the lower side also, I don't think we will go as low as US inflation will eventually go. So that's why. So that's 1 second. Just give me a second. Sorry. So that's why we are not going to see that kind of rally which US will have. But still, if we start to seeing some kind of rally in US and we start to see some kind of growth deacceleration in India, then there's a possibility of rally. Since it's too far away, 6-8 months down the line, I cannot be very confident of that happening. It's too far for a fund manager to predict. But I would say that there is a probability of that happening. And fixed income, when you're looking at fixed income allocation and you're coming at a good levels, then there is you should always be aware that there's a possibility that you can have some kind of MTM gains also. So that's why it makes sense to start allocating money to fixed income markets. And once you get more data that India growth is faltering a bit and US rates are going to go down, then obviously then you can start increasing your allocation to that category. So that's broadly the thought process right now. Coming to liquidity outlook and everything. So if you again, yeah, so this is the curves right now, right? So you'll find that these curves are the flattest which we have seen in last 3-4 years. So 2x5 is the lowest level which we have seen last 5 years. You can see similarly with 10x3 year GSEC, is the lowest level which we have seen in last 5 years. So what it means for a fixed income investor is that it's a very good point for them. They can come at whatever risk point they are most comfortable with and still get a very good rate. So a 2-year, if you're coming for a 1-year duration, 2-year duration product, you are getting 740, 750 kind of gross rate. If you're coming for 5-year duration products, you're still getting 750s. So based on your comfort level, investors can get a very reasonable and a good rate. And it's very easy to pick and choose what is the most appropriate duration product for you, and you can still get a very good rate. You don't have to make that kind of risk reward adjustment which you normally do in a steep. So this is excellent point for investors to come in. As I said, the curve is very, very flat, and it's excellent time for investors to come in. Again, just summing up, RBI and markets are on the same page. What this means that we are not going to see some kind of disruption in market as we saw last year. So this is not going to be a pain point for the markets, unless obviously some kind of data mismatch happens in terms of much better than expected data or much worse than expected data. Then we can see some kind of market movement. Otherwise, market in next 2-3 months or 5 months are going to be very stable markets, and hence people should not worry too much about their entry points. They're not going to incur immediate MTM gains or loss if they enter currently. The not so good is that inflation remains a bit sticky, as I said. However, on the plus point, a 6.5 range is appropriate for a 5.5 kind of inflation. So it's not a very big worry. The second is that, as I said, while we can see some kind of rate cuts in US, we can see, but same cannot be seen by us. So as a fixed income manager or an analyst, we can obviously only project things with a 3 to 6 month year kind of horizon. And with that horizon, we don't see a rate cut happening, right? It's something which can happen, but it will happen somewhat in a distant future, not in a nearer future, as we can see right now. What can work? You have a very flat curve. So you have carry cushion across the curve. Whatever risk point works best for you, you should look to enter. The short-term products like short-term fund, corporate bond fund, or PSU all have a carry, gross carry at around 740 to 750 kind of level. with duration ranging from 1.5 to 2.5 years. These are moderate durations which are not going to harm you if you have allocation for more than if you have allocation investment horizon of around 12 months, 18 months. So these are things which fund managers should start, sorry, investors should start looking at. So these are broadly what we feel. Mr. Krishnamurthy, anything else you want me to cover, or?
No, I think by and large, I think you've covered all the points, except if you could give us, I mean, I think I saw the slide also, right? Like you said, if once somebody is looking at the short term, would you recommend an ultra short kind of a fund? And if it's a period of say 1 to 2 years, a short term fund, and beyond, you know, those kind of things. But I think we can leave it for the Q&A, Pranay. You can go ahead. First, I wanted to ask a question. You've been talking about you know, another 2 rate hikes at best that you know, US may kind of think they continue to be hawkish, but it doesn't seem like you know, they're going to go for a big push on the other side. And I also read the papers a couple of days that the MPC is also kind of wants to go for a you know, kind of a policy stance where they want to hold any further raises in the immediate term. So all this, so from an investor standpoint, and if somebody is really long-term in their view, and by long-term, I'm talking about 3-year plus kind of a thing, would your Lakshya fund, which is, you know, essentially a GSEC-based fund, make sense? And could you give us your views on that and the specific thing that in a 3-year perspective, if that fund could be a good investment option? Of course, GSECs always carry a little bit of risk in them in terms of MTM and the way market they behave. But apart from that, would that be a good thing for people to look at? Or is there any other game within the debt space that people could look at, say, a double-digit return over the next 3 years? Is there a possibility for that?
Yeah, great points. First, in terms of Fed and everything, as said, Fed would keep on sounding hawkish, but it's more important to follow what the future markets are saying. If you follow the future markets, you'll find that they are expecting a couple of more meetings with rate hikes, maybe 50 to 75 basis point rate hike, 75 basis point of rate hike, and that would mean that by March it should be over. Similarly, for RBI, people are expecting that we would hike by another 25 basis point and we should be over by Feb of this next year. So to that extent, unless we see some kind of big deterioration in macro data, we don't expect these rate hikes to meaningfully impact markets. And hence, as I said, the short-term funds and all these funds remain very good point for entry, given that the YTMs of these funds are on a gross basis already at 750, 760 kind of levels. So that's the first point for any investor looking at 1 to 1.5 year kind of horizon. For Nivesh Lakshya fund, see, the way we position this Nivesh Lakshya fund and we sell to investors is that it's a fund where a person who is looking at investment horizon of more than 7-8 years should come, right? So we won't recommend it to a person who has 3-4 year kind of horizon. Why? Because the fund is a fund which has been structured in such a way that if you hold for a period of 7-8 years, even if the rates go higher or lower, your returns would be broadly in around the YTM which you have entered. So just to give example, if you have entered at 7.5 and say After 7-8 years, you find that the rates have gone to 8 quarter, you will find that your returns are broadly still around 750, 760. And vice versa. If you have entered at 7.5 and the rates have gone down below 7%, after 7-8 years, you will find that the returns are still around 740, 750, right? So because how this fund is structured and because of the longer nature of the fund and the longer maturity investment horizon we recommend to the investors, uh, we find that the returns broadly work out quite decently well around your point of entry. So, so to that extent, we don't recommend this fund to people who have an investment horizon of 3-4 years, because obviously in a lower interest rate scenario you will have some kind of MTM gains, but in a higher interest rate scenario you will have some kind of MTM loss also, right? And hence, for a person who is looking to do some kind of MTM, some kind of retirement planning, we would not want them to have that kind of surprise, right? Because if you ask me for a 6 months view, I can give you, but if you ask me 3-4 year view, obviously that's something which is beyond me, right? So, frankly, with that 3-4 year horizon, I won't recommend Nivesh Lakshya. But however, with a 4-year kind of horizon, we can recommend our dynamic bond fund. It's a fund which has a YTM of around 760, 770. It's composed, it's 100% sovereign. It's again a roll down product. And it's 7-8 years kind of product, which as a passive product. It's structured in a similar way to the Nivesh Lakshya, but it's recommended for people who have horizon of 4 years. So it's practically it's run in the same way as Nivesh Lakshya is done. The YTM is also very similar. There are only 2 points of difference. First, it's shorter maturity compared to Nivesh Lakshya. Nivesh Lakshya is a 22-year fund right now. It's a 8-year fund. And second, it's 100% SDL as compared to Nivesh Lakshya, which is 100% GSEC. However, the SDLs which we are exposure which we are taking in this fund are of the highest quality and highest liquidity, like Gujarat, Maharashtra, Tamil Nadu, Karnataka, etc. Right? These are the 4 and 5 states we have always taken, and beyond that we don't venture out. So investors don't have to be worried in terms of any kind of liquidity risk in this fund at all, because these states are very liquid, and it's we don't face any issues when we manage this fund. So we would recommend for people with a 3-4 year horizon, we would recommend this dynamic bond fund for you. Apart from that, as Ashwin will show you, we have all kind of target maturity fund, be it in 2027, 28, 30, 36. So for all kind of investors, we have those target maturity index fund. These are SDL only, these are GSEC only, these are combination of GSEC and SDL. So we have whole bouquet of target maturity fund for people who have investment horizon ranging from 3 years to 15 years kind of thing. So obviously, I understand your question. You are thinking in terms of some kind of MTM gains also. So you can obviously then look to invest in a target maturity fund with a higher duration to get those kind of gains. But as I said, if you invest in a 2036 kind of index fund, which is very liquid, which is comprised of 13-year GSEC, you will get quite good amount of gain if rates rally, say 1 year down the line. So these kind of funds we can recommend. We can obviously share with you the whole list of those funds. Coming to the second point, 10 more than double-digit returns is something we obviously, as per SEBI rules, we cannot guide you on that because that's something we are not allowed to forecast and those. But if you feel that you have a view on rates and if you see US rates going down, then obviously you can see, and India follows that, you can see some kind of MTM gains in Indian fixed income market also.
Thank you. Thank you, Pranay. Friends, the floor is open for any questions that you may want. Like I said, equity is a very easy game to understand. Stock markets give you that returns and very unpredictable. Debt is more interesting and more complex, so it's a little bit more needs a little bit perspective, which is where Pranay's conversation over the last 45 minutes has been hugely interesting for a lot of us. So please do come up with your questions. You can put it up on chat, or unmute and ask your question as well. Pranay, I'm going to ask a really, really dumb question, but I get asked this question very much by retail investors, right? So there are these people, even though they may be in their 50s and 60s, and today return is very, very important to everybody, right? So even if they are 60 or 70, they say, why not I put all my money in equity market, right? Why at all should I look at debt? Because in some sense, equity markets over the last 2 odd years has shown tremendous returns and has given the feeling to people that, it's a kind of place where they can expect great returns. While on the contrary, the debt market returns, both in the traditional bank deposits to everything else, has been very, very low single digit, right? So it gives a sense to people that, I'll play the pure equity game itself. I'll stay invested in equity mutual funds for long term, 3 years, 5 years. Why should I at all get into this asset allocation? Why should I keep debt funds, short term, medium term, and those kind of products, and so on and so forth? So for somebody like that, what would be your answer?
So for somebody like that, I can only cite what has happened in past, right? Future, I'm as clueless as they are, or as most people are. See, from 1990 to 2015, Nikkei index gave 0% return for 30 years, right? So obviously we are swayed by USA, which equity has given so good return. But if you see China equity, if you see many emerging market equities, if you see Japan equities, for decades they haven't given any return. So to say that equity will always give me a return is something which can happen. It cannot happen. It's not a given, right? So and nobody can see a decade in future. I don't think I can see more than tomorrow, but I'm sure that nobody can see a decade in future. So that's why asset allocation is very important. Obviously, you can feel very strongly that equity is going to give me excellent return, but still asset allocation is going to be important, because despite how strongly you might feel, things might not transpire. Suppose if Warren Buffett was born in Japan, he wouldn't have been famous, right? Because 30 years, Japan hasn't given a return, right? He was in the right country in the right time, right? So there might be a person who is as good as Warren Buffett, but he was born in Japan. So this is something which is a matter of luck also, right? So it's not given. Even if you see China returns, so despite so high growth, you will say Japan obviously has low growth. If you see last 1.5 years, 1.5 decade of China return, you will see they're very, very low, right? Despite very high growth country, it being a very high growth country. So again, it's not a given that it's not a God-given right that or rule that you will get return from equity. Coming to India, in 2019, if you would have taken a decade of return of, say, a gilt fund against Nifty index, you would have find that gilt has outperformed the Nifty index for 5-year, 10-year period. Only in 20-year period was Nifty index was outperforming. So again, India also, there has been phases when fixed income has outperformed equity and vice versa. So the same point stands for me. It's not a god. There's no rule that this should happen that way or that way only. Third point, if you plot a very, very long history of how 10-year G6 return have been and how the Nifty has behaved or index has behaved, you will find that the extra return which these have given have been only 1.5 to 2%. So for 1.5 to 2%, you are getting so much of volatility, right, in equity. So is it worth it? And it depends on person to person, but I'm not sure that 1.5 2% is something worth all the walls. So again, as a long-term investor, obviously you should allocate a good amount of money to equity, but there would be some amount of money you want to take out, and you will find that you would want to take out money when it's the worst case possible, right? Jab economy is bad, market is bad, then only we would need the money, right? Liquidity you only need when there's no liquidity. That's the golden rule, right? So if you have money in equity, all money in equity, then you will be always be taking out money from equity at the worst possible time, and then you will realize that your returns are going to be, the experience return are going to be bad. So my only reply to this is that that's why if you see all kind of factors, you will find that it's better to have asset allocation, and it's important, as you are suggested in the first line, to change this mix slightly, right? If fixed income market has given very bad returns in last 2 3 years, there's a good chance, and fixed income market is a mean reverting market. There's a good chance that it will give you a good return next 2 3 years. If equity has given a good return in bad return in last 2 3 years, then there's a good chance it will give you a good return in. So this kind of alteration and allocation changes are important, and one should never be 0 1 in their thought process that there is some rule that this will transpire, this will not. Financial market don't have any rule, unlike the physical world.
Thank you so much. Thank you so much, Pranay. I think very, very valid points. Friends, I don't see any questions. I have lots of questions, so I'm going to keep shooting them. We are well past our scheduled time, so I'm going to ask my last question, Pranay.
Sure.
Will the budget see a debt ELSS scheme finally happen? What's your view? As I think that's been the demand from the mutual fund industry, that we see a debt ELSS, which is a tax saving fund, which is based on debt products per se. When you can have a 5-year bank deposit, get tax benefits, why not a debt scheme that provides tax benefit? A very valid question. Do you believe that time is ripe now? Will this also provide for deepening of the retail debt market, given that, you know, people are talking about SIP, equity SIP, really kind of bolstering the equity market in India? Do you think such a move will also enable deepening the debt market at a retail level? What are your thoughts?
So see, when if you do indexation and you get decent amount of benefit from indexation, right? You pay 20% after indexation, you will find that the net cut is not that much. So to that extent, you don't pay a lot of tax if you use the indexation benefit wisely. Coming to the second question, will it happen? I have no clue on that. It's impossible to predict what government are going to do in budget or what. We have been pleasantly surprised and pleasantly disappointed by budget all the time. So for me to make any kind of projection is not something I would want to venture.
Fair enough. Fair enough. So we're completely out of time. Pranay, thank you so much for spending your Friday evening, just as I said, on the cusp of Christmas with all our clients, and taking us through the debt market. Like you said, I too believe that the next 12 months will be a great time for debt, and we are very, very hopeful that debt investors will make money. We're already seeing a fair amount of volatility in equity. I think equity has generated great returns in the past, but we're very positive that debt would be the hit on the block, at least for the next 12 months to 18 months is our internal view too. And that you just kind of solidified that thought through your presentation and your talk. So thank you so much, Pranay, and wishing you and your family and all a Merry Christmas. And thanks to the entire Nippon Mutual Fund team, Ashwin and Balaji and all of them who made this possible. Thank you so much, guys.
Thank you, Mr. Kushmati. Thank you, Ashwin. Thanks for giving me this opportunity to interact with you. And wish you a very happy new year to all of you.
Thank you. Thank you, sir. Thank you so much.
Thank you. Hello.